Now, every bank is going to look at your income differently, but what can you do to make yourself look like the best version of yourself to them? In this video, I'm going to look at exactly how the banks assess your situation and how to put yourself in the best position to get a yes. I've seen people with an $80,000 a year salary getting approved for a higher loan amount than someone with a $120,000 a year salary. And no, it's not because the bank likes them more, it's because their situations look very different when they're going through the assessment phase. Banks are in the business of lending money. That's how they make a profit. But they're also in the business of protecting that money, and it's their job to mitigate risk when they're assessing your personal situation. They'll scrutinize your income, your debts, your spending habits, and lastly, of course, your security, which comes in many different forms, which we'll cover a little bit later on. But it's all a balance, right? You could have great income, but no security. You could have great security, but no income. If the balance isn't right, then guess what? You're not going to get approved for a home loan. Now, this process I'm going to map out below applies for almost everybody, but if you're self-employed, the income situation is going to be very different, and that's something we're going to cover in another video. Let's start with your income, excluding super, of course. You'd be surprised how many people have no idea how much they earn and whether their salary includes or excludes superannuation. It's so important to understand because we can't use that superannuation income to be able to service your loan. That's because superannuation is something we cannot touch in Australia until retirement. Your base salary is the foundation of your serviceability assessment. This is what you're getting paid week in, week out, fortnightly, monthly, whatever it might be. And the easiest way to calculate your base income is to take the ordinary hours section of your payslip, times it by 12 if you're paid monthly, 26 if you're paid fortnightly, and 52 if you're paid weekly. Then we are able to look at non-base income, things like overtime allowances and bonuses. If you're an essential service, you might be able to use 100% of your allowances and overtime as serviceable income, where for the most part, let's say you're in construction, you can only use 80%. Generally, to get the best read on your non-base income that we can use for servicing, we will annualize your total year-to-date income in the financial year and then subtract your base salary. And that is simply how we calculate the overtime and allowances that are a part of your salary package. Bonuses, however, are something that are a little bit different. Sometimes you'll need an average over 2 years, other times you can just take bonuses from the most recent 12 months. Also, one little side note, length of employment, that is absolutely not a deal breaker. There are some banks that will approve just based on a contract, others just one payslip, but some banks will want you to be in a job for 3 months. So that myth is true for some banks, but it is not true for all. It just comes down to the lending policy of that specific bank. So that's what puts your borrowing power up. Let's talk about what's going to drag your borrowing power down. The first thing on our list is your debts or liabilities. Now, your HECS debt, as of the time of recording, is a big factor on your serviceability. That's because your HECS debt, irrespective of the limit, impacts your borrowing capacity dependent on your income. So the more you earn, the higher your HECS repayment is. The higher your HECS repayment is, the bigger impact on your serviceability it will have. So two people with $15,000 owing on HECS can have wildly different effects on their income serviceability depending on their income level. So unfortunately, the higher your income, the more impact your HECS debt will have on your serviceability. There are talks of HECS being excluded if it's going to be paid off within a year. At this stage, only one bank has implemented that rule. It might be widely adopted, but as of the time of recording, it is a big factor on your serviceability. The next thing is credit cards. No, you do not need a credit card to start yourself up a credit score. That is simply not true. Credit cards, although powerful, can have a big impact on your borrowing capacity because let's say you have a $10,000 limit. At any given time, you can actually go ahead and use that $10,000, so the banks need to treat it as it's been fully drawn down at all times if you have the facility open. If you are not emotionally attached to your credit card, I suggest closing it down prior to getting a home loan just to give yourself some flexibility in your borrowing capacity. A little known fact is for every $10,000 in credit card limit that you have, you will sacrifice around $50,000 in borrowing capacity. So just let that one sink in. Then we have personal loans. The most common are car loans. This is treated as a direct deduction from your income. Let's say you have $500 a month you are paying to pay down your car loan. The bank's going to take that as $500 less you have available to be able to service a home loan from them. And finally, it is buy now, pay later platforms like Afterpay. Let's say you have a $2,000 limit. If you were to fully draw down that limit, you need to pay it back in 4 fortnightly repayments. So when the bank assesses that liability, they will expense out that repayment on the $2,000 across 4 payments, which is a massive impact on your borrowing capacity as compared to, let's say, a credit card. My advice, shut them down before applying for a home loan. not for any other reason other than the fact that they are bad debts, and they start to signal risky spending behavior. Speaking of spending behavior, next we are going to look at your living expenses. Now, this is where it gets a little bit confusing. Banks will ask you to declare your expenses, but they'll compare that against a benchmark which they call the household expenditure measure, which fluctuates depending on your personal situation. If you are a couple, your HEM will be higher than that of a single. If you have kids, it will then be higher than a couple who has no kids. That's because your general living expenses will be higher given your personal situation. So even if you claim you spend $1,200 a month on your living expenses, but the HEM for your situation is $1,600, the banks will apply $1,600. One recent change that has started to transform borrowing capacities is the inclusion of body corporate or strata costs within standard living expenses. Generally, they have always been sitting outside of the standard living expenses with things like private school fees and personal health insurance. But now, because body corporate costs are more common than they are not, they have started to introduce those into standard living expenses because it is more representative of the actual household budget. Next, let's talk about loan stress testing. Once we have accounted for your income, debts, and living expenses, that money there theoretically is what is left over to be able to service a home loan. But here's the kicker. They won't use the actual repayment or rate that you'll be approved on to see how much you can actually borrow from them. They need to apply what is called a buffer rate, which is 3% on top of what you are going to be approved for. So let's say you're going to get approved at 5.5%. They will say, well, hey, can you actually afford this loan if it was at 8.5%? Which obviously means that the repayments you are being tested on are way over and above what you're going to actually be paying each and every single month. This here, again, is all about managing and mitigating the risk for the bank. They need to know that even if rates are to start going up, which they did not so long ago, that you will still be able to afford your home loan. Now into the next part of the video where we're going to talk about security. Once we have all of the income ticked off, you need the security aspect to be able to get you into that home. So even if all of the numbers work on your income side, you need security to make this all come together. No matter how strong your income is, how little your expenses are, if you have no security, you have no home loan. And security can come in many different shapes and sizes. Cash in your savings account, equity on an existing property, equity in your parents' property, or a government guarantee adding security to your home loan transaction. And what happens if you have less than 20% security? Well, you're going to need to pay lender's mortgage insurance, which isn't ideal. However, sometimes it is just the price you need to pay to play the game. Once we go down the road of lender's mortgage insurance, we need to also understand we are now subject to a whole different level of credit guidelines that the mortgage insurer sets. So although it really matters what sort of security and cash deposit that you have, it also equally matters what your income, debts, and expenses are all going to look like when we put them together for one big financial picture. So it's easy for you to go onto Google and say, hey, how much can I borrow on a $100,000 salary? But unless you're really getting all of the information into that calculator, you will never understand your true borrowing capacity unless you speak to a professional. Now, I promise to tell you how to make yourself look the best version of yourself for the bank. Well, it is simply keeping your expenses in check, staying stably employed, and at the end of the day, if you are someone you would lend money to, then guess what? The bank is probably going to look at you in the exact same way.